All right. Good afternoon, everybody. This is Saturday again. Saturday, 3 p.m., right? Our regular time to share knowledge, answer questions. And today, what we have for you in stock um, is this estate-related matter. A lot of times we get a lot of questions are really pieces out of the estate whole picture. And a lot of times people will tell you that, oh, you need to file 706, 1041, 1040. There's just so many varieties related to the loved one passed away. And so what exactly you really need to do when that happens. So today I am going to make it simple for you. This is the expertise we have in our firm, right? We try to make it possible for you to handle that on your own. Not to say that you don't need a community CPA anymore, not to say that you don't need your attorneys to handle your, and handle your events, handle your deceased parents' estate, and so that you can get through this hurdle and this life-changing event. But at least for you to know that exactly what you are doing. So I'm going to share screen with you and related to our firm. So number one, I want you to know we have YouTube channel, and all of our talks today and yesterday and the future talks, they're all coming into YouTube channel. You can find them right here. You can subscribe to the channel. So every time when we have a new video come out, like this one, it will send notification to you, so you know that, oh, Ying just talked about a lost loved ones, how tax works. So with that, and this is your library. We have over 800 videos inside of this channel, and you can pick on any topic you want to look for. And for example, if you want to look for, 1041, tax planning, things like that, you put in the keyword, it will search for you. All right. And you also notice that our website changed. Our website has becoming more robust in terms of our clients' needs, to satisfy your needs. A lot of times you don't have time to call us during the day, and you just want to see us and have questions. Then you can literally go onto the appointment, and when you come to the appointment, you can select people that you want to talk to. Right now, we uploaded the partners here, so you can see, with Danny Kim and the partner on business consultation side of things, so you can talk to him and you can book his time and look at his calendar. So this is more advanced feature we're introducing to our clients. So now let me just start going into the topic of the day and, go through what I prepared for you. And we do spend time, our staff does all the research, and the Tarek in this case, and did the preparation for the webinar. And I go in to, fine tune the details, making sure that it's targeted for what we want to explain to you. And then we use our time and your time and to comprehend this not frequently happen life event. Because when it happens, and you will be, other than surrounded with all these sadness, and one more anxiety you're going to have is not to know what to do with the taxes, right? So let's get going. Right before we talk about anything technical, we want to brag about ourselves just a little bit. And Community CPA received the Ethics Torch Award from BBB, and that is a earned recognition. So I am proud of what we have done, and I like to brag about that to you, so you know who you are working with. And I also have a book published in 2019, and it's called Community CPA. It's called Community CPA Bibles. We use that to guide our clients through the business journey. So the first book is Appointment with Ying at 8 a.m. 8 a.m., just beginning of the day, that's where you start up a business. And I am finishing up the second book called Appointment with Ying at 10 a.m. 10 a.m. is a time to grow in your business. So that is the book to guide you how to grow your business. And 2 p.m. and 6 p.m. are coming in. 2 p.m. talk about how to expand acquisition and merger related to your business. Then 6 p.m. is talking about retiring from your business. That is definitely is a map of a life, but is more accurately a map of a business life. How you start with this baby and end with retiring. So I literally write that based on our client stories. I also write that based on my own journey. So it is a book very relevant to you. People who read the book always tell me that it is so easy to grasp, it's so easy to understand, and I felt I understand how different people start up a business. So a lot of good comments for that. So I want you to go on Amazon, look for my book, and knowing that this is the business Bible Community CPA gave to you as you are looking at becoming a business person, entrepreneur. Of course, all of the technical things we talk about here and is covered under this no responsibility disclaimer. It's a free knowledge and hand it over to you and learn from it. But if you are going to use that to guide your important life journey and you want to make sure that you get consultants to come in and you hire Community CPA to be your guidance and the technical experts to go through all of these life events. But do not just copy and paste on the internet because it doesn't really work that way. And knowledge is so fluid. It just changes all the time. And also everybody's understanding can be so different. And did I tell you a study at one time? There was a tax cases and 43 CPAs are doing the tax return for the same cases. And they came up with literally 42 solutions. So when they asked which solution is right, all of them are right. And it's just a different point of view. So with that said, it is so different when you take on a approach based on your understanding. So it is a good idea to look for the advisors who understand your situation, who are in your kind of familiar with your life, instead of looking for someone who is far removed, probably deal with Donald Trump's taxes. No, you don't need Donald Trump's accountant to do your tax return because he's not available for next 5 months. All right, so I'm getting into really plain language, and I know there's a lot of jargon coming to estate tax, but you don't need to really worry about those jargons. I'm going to break it down to Chinglish. Remember, there's a word about the way I speak English. It is either Chinglish or Yinglish, but it's Yinglish, because that's how I do it, because English is not my first language. I learned English when I'm already in university. So my English really represents layman language, I would say, and I will interpret that to you. But my knowledge is way up there. So I can explain higher level of knowledge in a simple Chinglish. Here, the dead person and the dead person's leftover, okay, we call that estate. So what is estate? Estate is the dead person's leftover, not the food left over, but the things left over, the money left over. Things belongs to the dead person, but left over. So that dead person is our loved one. And I want you to forgive me for talking about that person like a piece of object and it didn't really have tears in my eyes. And I just want to get that concept to you, right? So the dead person is that individual. This individual probably passed away during the year, right? 365 days, one of those days he passed away or she passed away. So before this person passed away is a person. So that person needs to file 1040. Just like you close out your business, you need to file the final return, right, for the business. So if you're dealing with a loved one passed away, and in 2022, 2022 is the last year tax return for that loved one. So that is one entity, is the person. That social security number with that 1040, it's going to conclude. It's going to be like done. You need to file that return. And you may tell me that, well, my mom didn't have a lot of money, so she never really filed income tax because she doesn't need to. So what do I do? Well, the idea is you file a final return, you conclude. So, but if you don't file final return because this person don't qualify and it doesn't really make a lot of money, don't need to, of course you don't have to. But it is a different concept. Are you telling the system to say this social security number and this person is concluded? Or are you going to say to the system that, well, I didn't do conclusion and it's just like a missing person. The 1040 is just not there. And eventually the social security will be diminished. So you can do that, right? But I would say it is my own lifestyle. I like to see things be concluded properly. If this person is your loved one, it doesn't matter. You file the final 1040. Okay? So now you have a final 1040, you got it? But what is 1041? So 1041 and 1040 is only one number apart. 1041 is also an income tax return, but it's a return for the fictitious person. It's the passed away person. It's the dead person now have an estate. So basically, after that person dies, you will open up, you will assume, you will envisioning the leftover stuff. It is a entity. It is a kind of fictitious person. So whatever leftover stuff, maybe this person has a money printing machine. After he passed away, the machine is still printing. So he's still making income. But the machine hasn't been passed on to the children yet. So between the day he died till the day that the kids got the machine was printing money and still making income. Where do you file that? That goes to 1041. I know it's illegal, okay, for you to have money printing machine, and I'm just want to impress you about that idea. So basically, say you have a rental property, and you die. Then the rental property is still collecting rent. Your tenants still have to pay rent even though you die. But what if the property did not pass on to somebody yet? It is under your name, and you are done, and then it's still collecting income. That's where the 1041 comes in, folks. Got it? Right? So that is your second tax return, and for triggered by you are gone. Make sense? So now let's assume this house you have is a rental property, and you got this income out of the rental property, so you file 1041. But you die in November, and in December the title passed on, so the income is just a month and a half. So you file 1041. Of course, if it is less than $600, you don't need to. So it's like if you got a little bank interest coming out, you don't need to. But if it is more than 600, yes, you have to file 1041. But let's say this house is an asset, right? It's a leftover of yours. Let's say this house is actually $13 million in 2022. So now what do? You're going to file 706. So 706 is a tax return you have to file for this leftovers. And the leftovers are not valued at the time you bought it. It is valued at the time you die. So maybe you bought for $1, but now it's $13 million. You need to file 706. All right. The reason I say $13 million because it's actually, you know how the estate tax threshold has been changed down and up and down by the president. You know, they all come on board and then they change that. You know, I bet you if you have a president who is younger, in their 20s, you know, we would never do. But let's say you got a younger president to come in, then he may not be or she may not be too interested to bother with estate tax. But when your presidents are at the age and they can easily hop off the earth, and, you know, estate tax is kind of a thing because they are not the people with a few dollars don't bother with 706. Majority of our clients do not need to bother with 706 because they don't have over $12 million left over. But of course, when I say most of our clients, I really, you know, for me, we, you know, I established Community CPA, practice all the way to here. I am getting older. So a lot of our clients who followed me for 27 years, they're getting older, and their wealth is accumulating. So who knows? I will have a lot more people qualified to file 706. But this is a slide really important. I want you to envision a body, physical body, a made-up body. The physical body died, you file final 1040. The other imaginary body, which is all the leftover of your asset, that one, you need to file 1041 and 706. Depends how much you got, you know, income in between. And the 1041 could be filed year after year. And for many years, if you just have so much going on with your estate and the, you know, settlement and the people not happy, and a lot of fight, then you're going to have 1041 filed multiple years. But that 706 has a deadline. It needs to be filed. So the total years on that is 15 months. So it's a 6 months plus 9 months extension, 15 months, you got to file 706. So with that said, you sort of following me, right? You follow me. And if a loved one passed away, you're looking at a 3 tax return. If you're not ultra wealth, forget about 706. But if you are, if the parents left over something or making income, and then you're kind of looking at 1041. Otherwise, it is just the final 1040 you need to file. Now, who is responsible when our loved one passed away? You know, of course, if your parents, one of them passed away, and, you know, a lot of things are very simplified because the spouse is there, so you don't need to really go through a earth-shattering kind of process. But there are people responsible for taking care of the afterlife event. So these are these categories, and I listed here: executor, trustee, and the personal representatives of estate or trust. So these are people with authority and to file your tax return and to distribute your assets and to submit money. My peanut doesn't like me to have a voice issue. So every time I stop talking and then he barks, you know. So that's really cute. So I have him right around here. So these are the people responsible. So I want to draw your attention to trustee. So trustee, in the sense, you know, if we read through this, a trustee is a person or firm that holds and administers the property and assets for the benefit of others and another party. So that can be understood by your sales tax. You know, your sales tax is handled by you, but you submit it to the government, right? So you are actually, if you are the business owner, you submit sales tax, you are actually considered the trustee for the government because you are collecting other people's money and you submit that into the state, you know, revenue department, right? Trustee may be appointed for different purposes, such as in the case of bankruptcy and charity and trust funds. Then I was just giving you an example of the trust fund. You know, the trust fund, other than sales tax, is the trust fund. The other famous trust fund is actually your payroll tax. That is your trust fund. You really don't have authority to use it, spend it. You're just trustee. You hand it over to the government. So you have fiduciary responsibilities to the beneficiary, and you make decisions in the best of their interest. So if you are trustee for a deceased person, and they told you in the trust document, they told you that they want to distribute their asset in certain way, not divided by the 3 kids. In the trust document, they say the older one we don't like, and we don't want to give anything to her, and we like the other 2 boys, we give them more. I mean, you are a trustee, you're going to follow the trust document and to do things in the best interest of your beneficiaries. So, you know, with that said, you actually have that duty to process your trust, to process the dollars, the asset properly. So, you know, depends on if you are a child of the deceased person, then you could be the executor. And you being the executor has a larger responsibility and with potential, you know, disastrous events. For example, if you are executor, you know that your mom and dad owes a couple $1 million taxes, and they also have a couple $1 million asset, and you just distribute it out to your other siblings, and then you could be personally liable for all the taxes your mom was supposed to pay and you did not pay. So just be understanding that being an executor, trustee, or, you know, and a PR person, personal representative to a estate and trust, you have a lot of responsibility. And responsible for what? I listed it for you. Collect all the descendants' assets. You got to know what they have. Pay descendant creditors the money they owe. Distribute remaining assets to the beneficiaries. Apply for employer identification for the trust. If your descendant has a living trust, that turns immediately to be a entity. And it used to be called revocable, then become irrevocable. And then you would have a EIN number or TIN number, tax identification number, right? And file all the returns. Look at that. And pay taxes determined by the date of discharge of duty. So you need to pay taxes. And you can't be walking away from your responsibility and not getting taxes done, right? And in the absence of the court-appointed representative, the IRS will allow a person in charge of the property of descendant to file descendant income tax return. So what that means is, let's say you file the descendant income tax return, and you are the one doing it because, you know, the descendant is already gone. So you have a right to do that tax return for the descendant. Surviving spouse, of course, if one person passed away, the surviving spouse will file joint final return. And if there is not a surviving spouse, then you will be handled. That personal filing is usually handled by trustee, by, you know, the children, personal representative, and if, you know, in the bankruptcy, there's a different proceeding, but it will be filed by the bankruptcy court, the receiving non-probate asset who understands the work, the beneficiary receiving a non-probate asset who understand the work. I actually don't understand the sentence. So, but that's who is responsible and to file the taxes. In a lot of our clients' situation, and I think our clients' children are coming in to do those tax returns. A lot of times they come to our firm, those mom's tax returns, final year, please help us. Does my mom need to file 1041? Does my mom need to file 706? And we would be able to tell you and what kind of return she has to file. And then final tax return has a couple notes I want to mention to you. And one of the big thing is when you file the final tax return, the return, you would want to mark that as a deceased return. So inside of the form, there is a place you can actually write deceased on the top of the 1040 banner, and that's where you put that. And at the end of the second page, where it says the third party designee should be checked yes, because then you can actually have IRS contact you instead of looking for the deceased person, right? So don't pretend the deceased person is filing his own or her tax return. Just making sure the filing is really done properly so the IRS can follow through. If you got a refund, you can actually receive the refund, deposit into your estate account. So that way, and you can treat that properly, right? Then, of course, I have an example here quickly for you. Mr. Smith passed away on November 1st last year. The final return for Mr. Smith will need to be filed for year 2022 before April 18 of 2023. You know, I know our tax due date changes a little bit because of the weekends. So in 2023, for 2022 tax return due date is April 18, 2023. And then without extension, folks, and you can also file extension for Mr. Smith and file final return by October 16 if you file the extension. And I put in one sentence here to say that accrue method. You know how when we file 1040 and we actually receive those documents from IRS or other business affiliates, so we know what to file. It is all in there. But if it is income we were promised but did not receive in the current year, cash, the taxpayer is always on cash method. But for deceased person, that changes. So if you know that person gonna receive this money, put in the tax return so that you can file the final, including the income that is forthcoming but not yet here. All right, then file 1041. So this is where I said that as soon as the person pass out will still come back, so it has to be gone out of earth forever. So that date, their departure from earth, that is the date your 1041 would start. So yes, 1041 must be filed if the annual gross income is more than $600. So in this case, John Smith has a rental property. He passed away on November 1st, so he had a 2 months rental income that comes in, and the property didn't go anywhere because John, let's say he's single, so he passed away and he has a son, lives in Puerto Rico, and it's just gonna take a little bit for the son and to get the title passed over to him. And maybe the son don't even want the property because he lives in paradise and he doesn't want to come to, Midwest, snowing every day. No, he's not coming in the winter. And so the estate gonna be open until he comes back in and with the title changing and everything, right? So now there is a 1041 need to be filed because between the son takes over and the dad passed away, then there is a money made by this fictitious property doesn't belong to the body of John, but belongs to the estate, right? Remember I said estate is a fancy term of leftovers, just like the dinner, food leftovers, life leftovers. But some estate can be a huge leftovers, right? There can be business running in the estate, and then your 1040, boy, it is going to calculate on the business income as well. So that is the 1040 return. All right. So 1040 and the 1041, that was 1041 return, folks. I just misspoke, I think, right here. But the 1040 and 1041 are both income tax returns. Just remember that. So so-called income tax, it has to be taxable income with appropriate rate when it comes to income tax, right? So with that understanding, you know that 1041 is just a fictitious asset and pretend to be a person and generating income, and you need to file taxes. So, and that will clear a lot of people. A lot of people are not clear about 1040, 1041. I have a taxpayer came back. Mom already passed away for 5 years, but 1040 never was filed, and she came to us and goes, I filed it. See here, I filed it. And we looked at it. It actually was a 1041. The final 1040 was never done. So don't get confused with the two return. And really, most of the people will definitely need to file 1040 final. But 1041, if you generated more than $600 income under this fictitious body, then you file. Otherwise, you are liberated from not filing it. All right, people get liberated for not filing 706. It's not a pretty return. And I will tell you that we file thousands tax return every year. But I would not say I file thousands and thousands 706. And even if pandemic can take over everybody's life, no, 706 is rarely filed and only by the ultra wealthy. And the time, look at the value. So for descendants who died in 2022, Form 706 must be filed when descendants' gross estate plus any taxable gift given during their lifetime is valued at more than 12.06 million. This threshold has been indexed for inflation, so it may increase incrementally year after year. I want to add one more thing. This threshold has been indexed for the characteristic of the presidents as well. So they come in, they mess up on the threshold, and then once they put on the new threshold, it's incrementally changed year after year. So this is a thing that really changes. And, if people, of course, we cannot choose the year we die, right? But people, if there is a choice for that, of course, the wealthy will choose to die when the estate tax threshold is a lot of millions. 12.06 million, no, not enough for some. So, this is where the 706 comes in. The Form 706 must be filed within 9 months of the date of death, and the extension give you another 6 months. This is where I say the 15 months come from, right? So the extension, as far as you file by paper, you mail it out. If you fail, if you are ultra wealthy and you fail to file Form 706, then the late filing penalty is 5% of the taxes you owe per month. This penalty maxes out at 25% of your total unpaid taxes. If you cannot pay, still file it by the deadline, because the failure to pay penalty is less than the failure to file penalty. Make sense? This actually applies to all of your penalties, late filing, even with income tax, right? You don't want to not file. You want to file, even if you cannot pay, because that's typically range between 0.25% to 1% if you cannot pay. But if you just don't even file, man, that's a lot more taxes to wait for you, right? I know this slide is something that I throw in just to say that there are people who departed from earth, left a lot of debt. So there's no estate. The estate is negative. And, we see that in the company, right? Sometimes we work on the company tax return. Boy, these people are running business, have a negative asset, and have a negative retained earning. and negative equity the whole time. So the company negative equity is equivalent to the person insolvent estate. Insolvent left over. There's no left over. There's a big hole. So they have debt need to be paid. But just remember, if you are the person in charge of the estate, for your mom, for your dad, they owe taxes. You know everything you have need to pay to government first. The federal government, the state government, all kind of government. Okay? So these government has right to be paid first. Not your brother-in-law, not somebody's relatives. No, that needs to go after the government. So I just want to make sure I point that out. And also, if you don't do that, and we have this case happens here. So a taxpayer, a person, he was in charge of the estate, and he distributed all of the money to the siblings already. There's 3 of them. He divided, and then he realized that, oh my goodness, Dad has so much debt. I need to pay. He didn't file taxes for the last 10 years. And Ying, can you figure out how much he owed? Then after we figured out, it's like $65,000 taxes that wasn't paid. So there, hey, you need to figure out how to pay the 65, can even distribute those money out. But of course, you can fight through the system to demonstrate that you didn't do that on purpose, or you personally should not be liable, but you still have to come up with the money from the estate to pay, as long as your dad's estate is more than $65,000, right? So these are the things, and just be really careful. And then handling fees. I know everybody asked about that, because after, mom and dad passed away, and we got a bunch of money from mom and dad, and I just felt like I didn't even do anything yet. It's all gone. And why do I have to pay so much fees? So I just want you to understand the fees that you're paying is come out of the estate, right? The more estate you have, the more fees you're going to have. So that's just the nature of it. And the fees you pay to the trustee, and the fees, or you didn't have your parents didn't have a will, and then you ended up in the probate court, and it's usually 3 to 5% of estate value. When we say value, folks, and if you owe $1 million property, let's say $10 million property, but $9 million is the loan, and $1 million is the equity. So when they calculate those fees, they don't carve out the loans you have. They actually count your whole estate value. So can be a lot of fees. So the state you live in, the size of your estate, how complicated your estate is, and whether or not someone had, debating on your estate distribution. They don't like it. I am an adopted child, and I was with your parents the whole time. And why the estate is only giving to 2 of you? I am one of the kids. I even took care of your parents. You 2 didn't even live here, right? Those kind of contests can go on, and then really you won't finish your estate easily. You're gonna end up paying a lot of fees. So to plan your estate in the living trust, to lay out things gradually, and some folks set up a living trust and never go back to look at it. And we had one client and died with a living trust, but one of the kids was never added in the living trust, because when they did the living trust, they have 2 kids. Then they got the 3rd one, and the living trust was forgotten, but it was there. So the whole thing needs to be somehow figured out, because one kid was left out. All right. So living trust, just like the word suggests, is a living document. It is you. So you want to do the living trust review with like your annual tax return, and just go in, review your living trust. Maybe nothing changes, and no more new kids, and maybe a new property, so you add into the living trust. So there's a lot of reasons for you to tie your living trust with your annual tax planning or annual tax filing with your CPA firm. So in our firm, we actually work on the living trust annually with people already set up a living trust. Once they finish their tax return, we go into living trust review. So it is always current, always accurate. We don't forget about any asset. And if something happened to you and your estate is handled in one piece nicely. I mean, we have seen parents who has done a good job for the children. We also have seen parents who are just literally messy. So the kids, even though the kids were already in their 60s, they would fight. So it's not good, okay? So it is easy to do it right while you are still living and making sure that you can literally work on your fees. If you have a living trust, you can define the fees and talk about the fees with your trustee. And with your children, they don't charge any fees, right? But if you do have to pay probate fees, get ready, 3 to 5%. All right, so the next few slides, I just want to talk about passing property after you die. So the property is under your name, you're gone, and then the property needs to go to somebody else's, right? And so these property passing to the surviving spouse is easy because you have a joint asset, you pass to surviving spouse, surviving joint tenant automatically at death is easy. Asset, if you have this asset under LLC, you have a partner inside of that LLC, then your partnership agreement would dictate how the asset is passed on. Sometimes it's the spouse will take over your place, or sometimes it's the partner has a right to buy you based on certain value, so we'll put money into your final tax return, right? So those are the things, when you have something already have another person's name on that asset, it sort of works it out smoothly because they have to work it out. Your partner has to figure it out, right? And asset passed on to designated beneficiaries are also easy. So you have your will, you say, okay, my asset goes to this child. It's easy. So it is already there. And just like your life insurance, your annuity, your IRA, all of your stuff, and you already have beneficiary. Remember when you set up 401k plan, and one of the paper they're never gonna let you get by. They will force you to do it. That is the beneficiary. So who do we give the money to if you die? So you put it on there already. See how important that is? You really need to update these things because many years ago, we have a client passed away, and the 401k was actually still under the ex spouse, the ex-wife, and the wife who has the kid with him don't have any money. It's still with the ex-wife. So that is why, it is it's your affair, right? You really need to think about it, and that you're putting beneficiaries under these policies and under these money bank account, and you want to update that one when you have a life-changing event, right? Or even if you got into a big fight with your wife and you just start to wondering whether you should leave anything with her, and maybe with your children or something. So these are the places you need to think. Trust asset passed to beneficiaries specified in the trust document. This is what I was talking about, the living trust. If you have a living trust, you already planned it out. And those living trusts, at the moment you die, they turn the color. They turn into it was a revocable one, they turn into irrevocable one, they get an EIN number. And so they become the phantom body. Now you're phantom body, right? All right. So this is about probate property at death. And in this section, I just want to mention to you that if you are a person has properties all over the country, you have a vacation home in Florida, and you have another one in California. I mean, you die. That the property if you don't have a will and if you don't have a trust set up so that can be distributed properly, if you go through probate, the probate court is a state-dominated court, right? So the probate court going to go by the state ruling, and you might need it. I highlighted this one because it is a big word for me, ancillary probate proceedings, which means that third-party probate proceedings. Even though you are residents of Minnesota, Minneapolis, it doesn't matter because you have property in Florida, and that property is going to go through probate in Florida. It is just, of course, there's a threshold of the value, but just imagine how difficult would that be when you get involved with probate court, not 1, not 2, 3, and 4. No, don't make your life so hard. Plan life on earth, and the heaven time is really the extension of the earth time. So there's no reason why we not look forward to how things should be when we are not here, right? And the income in the year of death, this is where I talked about the property. Now I want to talk about income, because the income actually or constructively received by the descendant before the death is reported on their final form 1040. So the word of constructively received, it just means that it is planned to come in. It is set up in such a way that it will just come in, and like constructively constructed to be certain way, so it will come. Remember I said accrual accounting, so same thing. What I'm saying is, even though he didn't really receive it yet, before he went to heaven, but it is going to come. Then you want to report that into the final 1040. Here I have some exceptions, right? Taxpayer can elect to report U.S. saving bond interest annually rather than waiting to report at redemption and maturity. So let's say you left saving bond, and the saving bond, and you can redeem them, so you can report all the income into the final tax return 1040. But of course you don't have to. Then the saving bonds must have a beneficiary to go to, so it will be going to the beneficiary. So these are details on the medical saving account, carved out education saving account. I'm not totally familiar with ESA account, but these are really just the special things that you can do differently if you come across that kind of money in the descendant account. So wages, of course, right? And wages paid after death reported as income to recipient in box 3 and not included in box 1 of descendant W2. You see, what that does is that, maybe the descendant passed away on November 1st of 2022, but it got a bunch of vacation pay or a bunch of pay coming in, or maybe even bonus depreciation at the end of the year that belongs to the descendant. Then that one, the income maybe not received by the deceased person, but received by surviving spouse. Then that is going to report it under 1099. You see, it is not under 1099 ERC, it's under 1099 MI miscellaneous, and then that way it is not reported as a W-2 on the box 1. It's subject to FICA, FUTA, and the Medicare tax if paid in the calendar year of death and reported by the employer on the descendant employee's W-2. So what that says is, if the bonus, everything is going to come into the W-2, then of course it's subject to these taxes, the employer already taking care of it. But if it is not coming to the descendant and it is 1099 miscellaneous and you do not pay self-employment tax on that, okay? Then income, on the partnership income, the same thing. The only thing I want to point out is, let's say if you are active partner, you passed away, then on November 1st, you passed away. So your partnership income in the month of November and December, that should not pay self-employment tax. So on your K1, I know you couldn't see it. I'm just saying that because I want you to watch over us from heaven, because just in case these kids on earth are not doing the right thing and is paying taxes that they shouldn't be paying. So your money, let's say your partnership return, here I have the number, and write you a 12,000 K1. Then 11,000 K1 is okay to be self-employment tax, actually 10,000, because you died on November 1st. So 10,000, you pay regular taxes and also self-employment tax, but the other 2 months you don't, right? So just make sure that you understand the partner side. Then there's more about respective of the descendant income. So these are talking about that accrual piece of income. We talked about that already. The best way to include in the descendant tax return. Of course, deduction, it would work the same. If it is a business deduction that is relevant to the income and had happened with the descendant before, then it should include. And the deduction are deductible when paid by the estate and the person obligated to pay. So these deductions can be used by the person who claimed that income, not the descendant. So that's the piece that we want to give to you. And living trust at death. So people who have a living trust, when you die, income received prior to death usually reported under the 1040, right? And the living trust with one grantor become irrevocable. What that means is, like, if the living trust is just one person, or the living trust was just a couple, but the first one already passed away, then the last one, when you pass away, that living trust become irrevocable. So it's no longer considered a grantor trust, revocable grantor trust. It's no longer considered as part of your 1040, basically. On the death of the grantor, so on the death of the last person, the trust continues uninterrupted. Remaining assets titled in the same name of trust are unaffected. So don't worry about the properties that in the trust, because they're not changing. They are not going to repay. And for income tax purposes, you just need to get a EIN number, file 1041. Makes sense, right? Makes sense. So living trust, file 1041, and also file 9955 if your living trust has so much value, so much, over 12.4 million, remember the threshold? Then you file the 9955 election to treat all your trust assets as part of your estate. So this is what really that complication comes in if you are facing 706. But like I said, right now, as of today, we don't have a lot of 706. We have filed 706 a couple of times in the past, definitely not by hundreds, definitely not by thousands. So with that said, most of my clients are the clients not really facing 706, but more of a 1040 and 1041 filers. So with that, I kind of did this whole thing. Man, I'm just so warm, hot, because it is so much to talk about, but I kind of want to make sure that you are with me. So if your loved one passed away and you need to file the final tax return 1040, and that 1040 can include the income that he didn't even receive yet, but you know is coming, and so you can conclude that 1040. And then if whatever he left over with you is in the living trust, And then the asset, everything is so well protected. You don't have probate issues. And you just need to make sure that the income, the asset is distributed just like what the trust says to different people. You know, this property is yours, let's change title, and let's make sure we got the quit claim deed going on and all of these things, right? So you move that out of the trust to the person. But if you did not move quick enough and the property made money, then you file 1041. So these are the things that you will do. But of course, if you got so much money and you're over the estate threshold, and who knows, maybe some president would come in like President Obama did and lowered it to 3 million. So the half of American would qualify for that. So, you know, then we all file 706. So with that said, and depends on which year you die, and depends on which president is there, depends on incrementally increase of that threshold. So if you're over that threshold, that's what we call the death tax. People don't want to pay death tax, and their wealthy people are moving properties and things out of their estate, right? Out of their personal belongings. So that way they don't reach to that level. But of course, there's people reach that level, no matter what they do, right? Elon Musk, I think, no matter what he does, no matter how many kids he has, so he would still reach that level. All right. So with that said, folks, and I will see you again next Saturday. And I hope that if this webinar is helpful for you, and give me a thumb up and write me a comment. And also go onto our YouTube channel and to subscribe our channel. And we are really surviving on your support. If I don't hear any one of you saying anything, I probably don't even have motivation to continue. But because all of your overwhelming comments and support, I knew that I am doing something meaningful. I know that Community CPA is a company that really hit the nerve of ordinary people. We pay attention to Community CPA because they're doing meaningful things. And I will talk to you again. Bye-bye. Have a good weekend. Bye.